Welcome to the Max Dividends channel, where we help people build growing passive income, retire early, and live off dividends. In every Academy case, we take one stock and run it through the same checklist so you can see step by step whether it really deserves a spot in a serious dividend portfolio. Today we're examining Parker-Hannifin Corporation, ticker PH. A global leader in motion and control technologies embedded across industrial machinery, aerospace systems, and infrastructure worldwide. We'll answer, how does this company make money? Is it a good stock to hold long-term? We'll walk through the Max Dividends checklist, test its financial condition with the 5-pillar secret formula, see what role it plays in a dividend portfolio, and finally ask if PH is attractively priced today. How this company makes money. First question, do I clearly understand how Parker-Hannifin earns its money, and does that business model make sense for dividend investing? Parker-Hannifin generates revenue by designing and manufacturing motion and control technologies embedded in critical systems across aerospace, industrial equipment, and infrastructure, serving OEMs, distributors, and end users worldwide. Cash flow is driven by a vast installed base that requires ongoing maintenance, replacement parts, and technical support, not by consumer trends or short product cycles. The core earnings drivers are diversified industrial segments, essential components and systems for factory automation, mobile equipment, filtration, fluid power, and process control. With repeat revenue supported by aftermarket needs and a large installed base requiring regular service well beyond any single capital spending cycle. Aerospace systems, hydraulic, fuel, and flight control systems for commercial and defense aircraft that operate for decades under strict maintenance schedules, creating long program life cycles and predictable aftermarket demand, even when new aircraft production moderates. Aftermarket and replacement demand, seals, filters, connectors, and motion systems that wear over time in mission-critical applications where downtime is costly, supporting recurring replacement revenue and reinforcing customer reliance on proven suppliers. Engineered solutions and customer integration, customization, engineering expertise, and global support that strengthen long-term relationships and anchor repeat business across multiple product cycles. In other words, Parker-Hannifin sits at the center of a broad installed base of industrial and aerospace systems that require ongoing maintenance and technical support, exactly the kind of structure that can support a long dividend record when paired with conservative financial management. Is this a good stock to buy long-term? Step 1. Dividend history. Our filter is simple, at least 15 years of consistent dividend growth. Parker-Hannifin doesn't just clear that bar, it obliterates it, with 71 consecutive years of dividend increases that qualify it as one of the most established dividend kings in the industrial sector. Annual dividend per share rose from about $1.30 in the early 2010s to roughly $7 most recently, with no visible reset or panic cut. For a diversified industrial and aerospace manufacturer exposed to global cycles, OEM production swings, and capital spending shifts, that level of consistency points to disciplined capital allocation and durable free cash flow across very different economic environments. Step 1 passed, Parker-Hannifin behaves like a genuine dividend eagle, with 71 consecutive years of increases and a shareholder return mindset that has endured through many industrial and aerospace cycles. Step 2. 5-pillar secret formula. First pillar, sales growth, the foundation. On a 10-year view, Parker-Hannifin's revenue rose from the low $11 billion range in the mid-2010s to about $20 billion most recently. The path wasn't linear. PH is shaped by industrial output, capital spending, aerospace build rates, currency moves, and the timing of large orders across diversified end markets. Even so, the long-term revenue base has expanded meaningfully, supported by deepening OEM relationships, disciplined acquisitions, and recurring aftermarket demand from a vast installed base. Sales growth past, Parker-Hannifin's resilient long-term revenue trend reinforces its case as a diversified engineering platform with a credible foundation for sustained dividend continuity. Second pillar, profit growth, the fuel. Over the last decade, profit rose from about $2.6 billion in the mid-2010s to more than $7 billion most recently. That suggests PH is not reliant on a single unusually strong cycle, but built on a profit base that can expand through changing industrial demand, portfolio shifts, and global volatility. Profit durability is supported by operating leverage, disciplined cost control, margin expansion, and a growing mix of higher-value engineered and aftermarket solutions. Profit growth past. Parker-Hannifin's expanding profit base reinforces dividend reliability and funds future increases. Third pillar, net income, true strength. Over the 10-year view, net income begins around roughly $0.8 billion, advances into the $2.5 to $3.5 billion range in stronger years, and finishes near about $4.0 billion most recently, ending closer to the upper end of the decade's range rather than pointing toward deterioration. That is precisely the resilience dividend investors need. A business that can remain solidly profitable through global industrial cycles, aerospace production swings, and acquisition integration without suffering a prolonged earnings breakdown. Net income past. A resilient and growing earnings profile reinforces that PH's dividend growth is supported by durable operating strength rather than a short-term upswing. Fourth pillar, dividend payout safety. Protecting passive income. Parker-Hannifin's payout ratio stays in a conservative range for a mature industrial company, typically moving from the mid-30% area into the 25 to 35% range in recent years. That conservatism is exactly what enables 71 consecutive years of increases. The payout is structured to remain affordable across the cycle rather than stretched to impress in good years. The ratio rises when profits soften and falls as profitability improves. Exactly the behavior you want to see. Dividend payout safety past. The payout ratio has stayed within a disciplined and sustainable range, supporting the view that the dividend is well covered and positioned to keep growing. Fifth pillar, debt burden, avoiding traps. On a 10-year view, PH's debt ratio spent much of the decade around the low 0.6 to upper 0.6 range, ending near 0.53 most recently. That suggests a balance sheet kept within a workable zone for a global manufacturer navigating acquisitions, capital spending, and cyclical end markets. The overall pattern does not point to rising strain. Instead, it shows Parker-Hannifin has preserved enough flexibility to fund operations, pursue disciplined growth, and support shareholder returns without sacrificing long-term stability. Debt burden past. Leverage trajectory appears controlled, supporting the view that the dividend is backed by balance sheet discipline. Parker-Hannifin's overall financial score comes in at 97, very safe in our framework, signaling strong underlying fundamentals and the kind of operational resilience dividend investors seek for long-term portfolios. Does it fit our plan? MaxRatio combines three signals: current dividend yield, dividend growth, and financial strength, to classify stocks as growth eagles, balanced eagles, or income eagles. Parker-Hannifin's MaxRatio is 2.77, placing it in the growth eagle bucket. With a dividend yield of 0.91%, PH is clearly not an income anchor today. The appeal is entirely in the growth profile: 104% cumulative dividend growth over 5 years, a payout ratio that stays conservative even through industrial downturns, and 71 consecutive years of increases reflecting a capital allocation culture built for the very long run. In practice, Parker-Hannifin is a pure compounder, a low starting yield designed to grow substantially over time as aftermarket demand compounds, margins expand, and management keeps raising the payout in line with through-cycle cash generation. It fits investors with a long horizon who want rising income from a high-quality industrial franchise and can accept a modest starting yield in exchange for decades of disciplined dividend growth. Is the stock undervalued today? Here the signals are mixed. Versus peers, PH screens as fairly valued in the Max Dividends app. The market is assigning it a valuation broadly in line with comparable industrial names, rather than a clear discount or an obvious premium. Versus its own history, the current PE is around 32.57 versus a 10-year average near 22.55. meaning investors are paying meaningfully above PH's typical historical multiple, not a bargain entry by its own long-run standards. On yield, PH pays about 0.91% today versus a long-term average near 1.51%, so the starting income is well below what investors have typically received. The dividend keeps growing, but a strong share price has compressed the yield below its historical norm. Analyst consensus sees meaningful upside, with a consensus 12-month price target implying roughly 15.69% upside, reflecting confidence in margin expansion and continued aftermarket and aerospace demand. Final decision. Parker-Hannifin is a high-quality Dividend King compounder priced at a premium to its own history, with a yield below its long-term norm and fairly valued versus peers. That is not a deep value entry, but for investors focused on long-run compounding, the 71-year dividend record and 104% 5-year growth rate make a compelling case for patient accumulation. For dividend investors, PH makes the most sense as a growth eagle with a very long horizon. A 0.91% starting yield paired with one of the longest dividend growth records in the industrial sector and the potential for that payout to keep rising substantially as Parker-Hannifin executes across its aftermarket base and aerospace programs. The key watch items are valuation discipline on entry, acquisition integration, and whether industrial and aerospace demand stays supportive enough for earnings to grow into the current multiple. Subscribe for more analysis. This is not investment advice.